Welcome to the Net Profit Podcast with Ryan Kibler, your net profit CFO, helping business owners like you grow their net profit one episode at a time. And now your host, Ryan Kibler.
Well, hello and welcome to another episode of Net Profit Podcast. I am excited to dive in today. We are doing a part 2 with Mark Dolfini, and we are diving into some financials again today. So highly recommend if you're tuning in just on audio, bookmark this episode or whatever you need to do. Make sure you go and review the YouTube one because I'm going to put some numbers on screen. Mark, thank you for taking the time and doing this with me.
I love it. This is my jam.
All right. Well, I'm just going to dive in. Quick background here. This is going to look very, very similar to our last example or data set, if you will. Only difference being that this is a different company. We have set this up as a small construction company. But same layout. So we've got, balance sheet here at the top. And Mark, I don't know if we want to just give them a quick review like we did last time of just break down the balance sheet real quick and income statement, and then we can kind of dive into the real scenario and see what's going on here with the numbers.
Yeah, this is great. So again, very basic balance sheet that we're looking at here, just starting with the most liquid assets at the top. Again, you've got a balance sheet, which is your assets of what you own, your liabilities of what you owe to others, and the difference between the two is the equity at the bottom. So Again, the most liquid assets at their top, meaning the most that are the most quickly convertible to cash. And these are generally cash, could be cash, total cash in a bank account, could be cash. And generally in larger companies, you're going to see something called cash or cash equivalents, right? So those could be cash, that could be silver and gold, like that's held in a bank vault, right? It could be CDs, these sorts of things, right? And then you got accounts receivable, that the amount of money that people owe to you. You got your inventory items, right? What kind of business are we looking at on this one?
So I set this up as a construction company.
Okay.
Like this, because of no inventory. I mean, this might be a company, let's just say that they, maybe build brand new decks and maybe they do deck repair, right? But it's not like they're stockpiling 2x4s, right?
Right. So they have basically a just-in-time inventory, which means that they're holding it in Lowe's lumberyard.
Yep.
Right.
Yep.
Which would, they might have an inventory of nails, or they might have, those sorts of things. But generally, it's probably those are the sorts of things that are not put into inventory. Those things are probably just expensed as they use them. So therefore, it wouldn't be appropriate to keep them and hold them in inventory.
Right.
You got your total current assets, which is adding all of those short-term assets up.
Yep.
And then your fixed assets, which could be things like your, trucks and landscape trailers and things like that. It looks like they don't have very many in terms of fixed assets.
Yeah.
So total assets.
Tools,
that's
things
some
like
tools.
that.
Yeah. Nail guns, things like that. Right.
Yep. Or, maybe, again, I didn't really think about that part of it when I set the scenario up, but they could have a truck that's maybe fully depreciated, right? And so maybe they're, driving around a vehicle that they've had for 5, 6, 7 years. And, now the technical value of it is zero. I say that in quotes, right? Because it's kind of a book value. But if they actually wanted to go sell the truck, they could get a few $1,000s for it or what have you.
Right. Well, a really cool strategy, and I know this is where something you would have to, and again, all the disclaimers, of course, you have to get your own attorneys, you have to get your own, tax professionals. But, I see a strategy that's often employed is that the companies that are engaging in the contracts. So go back up. Is this Mike's construction company? Is that what it was? Okay. So Mike's construction company, love Mike, great guy. Right. But the problem is, so Mike's construction company is entering into contracts with the homeowner, for example, right?
Yep.
So it's not all that unusual for Mike, because that's the company, that's the entity that's entering into the contract. That's the one that's more susceptible to lawsuits, right? Because that's the one where the contract is. So it makes sense then to hold the fixed assets in a different company, in a holding company that leases that to Mike's construction company. So it might be Mike's holding company. So Mike's holding company actually owns the fixed assets, like the trucks, the dualies, right? The big trailers, the compressors, and all the expensive equipment, and then leases that as a legitimate contract, a legitimate lease from the holding company to Mike's construction company. And that actually, in essence, becomes another form of revenue. So it's interesting though, like again, but this wouldn't work if Mike's construction company, of course, wasn't profitable. But that is an asset protection thing that I often see. And again, you have to do it the right way. You know, I mean, obviously, this talk to an attorney about doing that. So it doesn't make it to me. I looked at it and went, "Oh, okay. Like fixed
Yeah,
assets only being a few $100, that actually could make total sense to me."
for sure. Yeah, I think that's a really good point. And it also protects you from going the other way too, which is, you're driving Mike's construction pickup truck and you get in an accident.
Right.
And, if they want to sue there, well, they're suing the holding company that has the trucks. They can get to those, but they can't get to any of the revenue from the actual construction business. Yeah, that is a really good point. I like
Yeah,
that.
yeah. It's and I mean, of course, you can sue anybody, right? You can include anybody in
Sure.
the lawsuit, but if the contract is legitimately, if it's just like, hey, look, we just own the vehicle, we don't have any, I don't want to say it would be like, if a plane, crashed due to pilot error, it'd be like, well, they're not going to sue Boeing, right?
Yeah.
Because it was pilot error, right? It was Southwest Airlines, or it was, whatever. So that's what I'm saying. Like, this is why, again, talk to an attorney about this, but that is definitely, when I looked at it, I was like, oh, actually, that's not all that uncommon. Actually, and that's something you would see in the property management business, for example. Like, my property management company, the property management company enters into all the contracts between the tenant, the residents, and us, and then, and then the property management company and the owners of the properties. So, but all the assets are not held in the property management company. All the assets are held in a separate holding company, like vehicles and things like
Yep.
that. So, and it's just done that way more as an asset protection thing. So, because what's visible is the one who's entering into all the contracts, that's the liability is significantly limited.
Yeah. Love it. So I want to talk before we go down to income statement, and we're going to talk about a specific concept today. I just want to highlight, if you're looking at this on screen, massive, massive uptick in cash, 30K to 259K,
Wow.
massive increase, right? Now, a lot of business owners are maybe thinking, oh, that's fantastic, right? I would love to go from $30,000 in the bank to 260. But the big question is, how did we get there, right? And that's where,
Hmm.
again, before we go to the income statement, I just want to highlight payables are up. So a payable would be, like maybe you have an account at Lowe's where you can pick up material and then every 30 days they send you a bill, right?
Hmm.
Or it could be like a trash bill if you have an office or what have you, or it could be a credit card. You could put that in an accounts payable. So they have an increase there in balance, and that basically means you haven't paid your bills. And
Hmm.
so if we were going to fully pay that off or back down to this balance of 660 that they had in the previous year, that would take some cash out of the bank, right?
Hmm.
So again, if you got, if you're a business owner, you got a stack of bills on your desk that you haven't paid, you're going to have more cash in your bank than if you had paid those bills, right? They're definitely
Right.
due, but
Right.
you haven't paid them yet.
Right.
And then I just also wanted to highlight, current liabilities and total liabilities, we've got big increases there. So
Right.
this business is taking on debt. And so the cash in the bank, again, looks like, oh, wow, that's a fantastic increase. But we've also got to question, how did they get there? Right. And from here, I'm seeing about a $40,000, maybe $25,000 increase in current debt, and then about a $200,000 increase, maybe a little less, 175 in long-term debt. So, just from those items there, we've got increases in debt that fed into the bank to feed cash.
Yeah, that's a great observation. And this is something where, having someone with a financial background like you do, you're going to look at different metrics and not, I mean, you can, and trust and know, we accountants love to slice and dice our numbers, right?
Yep.
We just love
Yep.
it.
Yep.
But one of the ones that I look at is, when you're looking at your balance sheet items, is you got items as a percentage of cash or items as a percentage of total current assets, right? You've got a current ratio, something called a quick ratio. I don't want to get into all those things right now, but these are really important. Those are very, very important ratios to track over time. Because
Mm-hmm.
to your point, right, yes, the current liabilities did go up, but did they go up as much as the cash did? No, just the back of the napkin math on that. The current ratio actually went up quite a bit, which is good, which means that you've got way more current assets than current liabilities. Current liabilities are short-term debt, like credit card debt or notes that are due within 1 year.
Yep.
So that would be, so to me, yes, I love cash. Like, but to me, cash is the insurance policy because again, cash is king. The thing is, you've got to make sure that you've got that cash so you can deploy it properly and you're using it properly. But again, they are taking on more risk by taking on those additional liabilities of that long-term debt. So it doesn't come with, it comes with a cost, and it by itself doesn't necessarily mean it's a bad thing, right? Because again, maybe their terms are very, very favorable where they've got, the payments are spread out. So it's actually a very long amortizing loan. That could be a good thing, right? But it's just a question of like, and the metrics that Ryan and I are both talking about, it doesn't necessarily mean it's a smoking gun. It's just a thread to pull on. It's a thread
Yep.
for you to go back to a guy like Ryan and go, hey, hang on a second. Ryan, I noticed that this current ratio is up, which is great, but as a percentage of my total debt, it's actually down. So, let's talk about that. Okay, great. So now you can actually look at it and go, oh yeah, okay, this is what's going on. There isn't anything to worry about because you wanted to grow, you wanted to get access to cheap debt. It's got some payments, but the payments are actually pretty reasonable. It's going to be covered by cash flow. Or no, you've got really aggressive payment terms. It's going to take you 3 years to repay this, and it's going to be a rough 3 years. It could be either one of those two things.
Yep. Yeah. And, you were throwing around some terms there, quick ratio, liquidity, things like that. You know, I think you're looking at there, can you pay your bills in the next year and
Right.
how well, right? And, if we're looking at numbers here, the reality is today, there's $61,000 in outstanding current bills that are due, say, in the next year. You could straight up take $61,000 out of the bank,
Right.
right? Assuming that there's not outstanding like payroll to be paid or something like that, right? And pay it off. And you could really, really manipulate those numbers. Then all of a sudden you've got $198,000 in cash, zero due over the next current year.
Right.
And you take that into a bank and you're gonna look like a golden child, right?
Right. Right. Right.
So those can be manipulated. Those can change month to month as your numbers change. But again, I'm glad that we kind of talked about debt there and just pointed out how
Sure.
cash is coming into this company.
Right. Exactly. Yep.
So let's go to the income statement or profit and loss. I'm sure, again, probably a place where a lot of business owners feel really, really comfortable, with these numbers and this statement. There's a few things that Mark, you and I want to go through here and kind of highlight for the business owners out there. And today we're going to talk about a concept that, you talk about a lot, which is growing broke, and
Yeah.
how, just looking at your numbers in this way here, you know, in columns without actually looking at some percentages, it might be really misleading.
Right. Right. That's a really good point because you can't look at this in a vacuum. You have to make sure that if I said to you, Ryan, the stock market is 12,000, that means nothing. Like, what do you mean? What's 12,000? Are you talking about the Dow or are you talking about NASDAQ? Like, what does that even mean? Right. And even if
Yep.
you did have context, you'd say, okay, well, the Dow is at 30,000. Well, that's only means something compared to what it was a year ago, 10 years ago, right? And where you think it might go, right? And what direction it's headed in. So you can't look at any of these numbers in isolation. You have to look at it and reveal the story that it's trying to tell you. It's like opening up a book in the middle, reading one paragraph and thinking you're trying to understand all the different complexities of the characters. You don't know if you're only looking at one paragraph, right? So this is where you have to let the financial storytellers
Yeah.
do their job, right?
Yep.
And that's why you have to look at everything outside of just one number itself.
For sure. For sure. I completely agree. So if we look here, Mike's Construction, they've got some sales growth or revenue growth year over year,
Yep.
and their cost of sales grew as well in dollars. But I want to go to, our presentation images here and just highlight percentage wise, if we look at things that way,
Sure.
they did not change. So their cost of sales, and let's just say this is their materials as far as, they go to Lowe's, they buy their deck boards and screws and all that, put decks together,
Right.
22%. Now, if this is a real life case study
Now,
with,
just to be clear, that's 22% of sales. Okay.
yep,
So what he's doing is he's dividing that number out as how much of that is a comparison. So even though you're looking at year A of $253,000 in year
yep,
B, just shy of $300,000, right? That's what's $47,000 increase. it's still 22% of sales. And that's a really important metric. That means you've got a real lid on your cost of goods sold. That's actually not a bad thing.
Yeah,
Sorry, I just didn't want to glance over that because this is actually a healthy thing. I mean, most times you see the number, go like, oh my gosh, 300,000, that went up that much. And you're like, whoa, back it down. Your sales actually went up quite a bit. And, that's almost like a roughly 10% increase in sales. And the cost of goods sold didn't change. Their cost of sales didn't change at all. That's actually pretty impressive. So,
yeah. I mean, I was going to say, if this was a business in our current environment where cost of things have been going up the last few years, things like that,
right.
this would almost lead me to believe that maybe this business is using like a cost plus pricing model, right? Where it's like whatever our costs are, that's what we're going to charge the client plus X%, because that's what we want to make, right? To pay
Right.
payroll and have
Right.
profit and all that, right? I mean, the idea that these costs are staying the exact same, I mean, just doing a price increase to keep those steady would be really hard to do over the last couple of years with the increasing costs that we've had.
I would agree. Yeah, that's a really good observation.
All right. Then we've got payroll up a little bit, right? Marketing expenses up a little bit, and overhead expenses up as well. Now, I think, again, as we've just talked, what's really important, what did this do on a percentage basis, right?
Right.
And I can go to that over here as well. So let's have a look. So even though we're up in dollars, this is really interesting as we look at payroll. We are down in percentage of labor cost from 35% of revenue to 33,
Right.
right? So very, very interesting. You could, look at this and kind of have the story of, okay, our payroll went up. I know we maybe hired an extra person or took on, another contractor that was part-time and we're paying them, but your payroll actually got more efficient.
Yeah, that's right. So it went from basically you have $39,000 more in payroll expenses, but as a percentage of sales, it went down. So it went from 35% of sales to 33% of sales. So it's actually, to your point, Ryan, is your company's becoming more efficient. Mike's company here is becoming more efficient. And that's why it's great to look at this as a percentage of sales, because now you're looking at apples to apples. You're looking at like it evens the playing field when you're looking at it from that perspective.
Yes. Now, in the other two buckets, marketing and overhead expenses, you are actually going the other way. So we
Right.
had increases in dollars and we had increases in percentages. Marketing went from 1% to 2%, and overhead went from 15 to 19.
Right. Not the
So
end of the world. I mean, it's not the end of the world, but when you're looking at it now, marketing expense was such a low net dollar amount, you might be saying, well, it doubled. How can you not be freaked out about that? Well, I mean, this is where I'm looking at my return on marketing investment, and, where I might say, okay, well, I had $100,000 increase in my sales, and that $100,000 only cost me an additional $14,000. Right?
yeah.
Like, okay, how do I do that as many times as possible? Right. So
Yep.
if I know it cost me 14,000 to get an additional $100,000 in revenue, and I think it was more than that. I think it was about 150,000 increase.
Yep.
What was that? Yeah, about
Actually
100,
almost 200.
almost 200,000. Yeah, actually almost 200. So just shy of 190. So let's say it's 190. So again, to pay $14,000 in marketing expense to have a $190,000 increase in sales. Okay, yes, please. Can I take three more of those? Right.
Right.
And that's exactly how companies scale, is that they can scale well if they keep a lid on their costs, they're tracking their things, and they know at that point it's a math problem. So I'm not overly concerned right now. Of course, there's other things to look at, but as I'm looking at marketing expenses, the fact that it went from 1% to 2% is not the thing that I would be overly concerned with, just because the marketing expense dollar itself is so low.
Yeah. And to your point, right, just to kind of break this down, make the math easy, put in $1 into marketing, get out $13.57.
That doesn't break my heart.
Right? I mean, realistically, right? Take that to any marketing agency in the country, right? They would want a testimonial from you. They'd be like, look at these numbers, look at the returns we've gotten, right? And as a business owner, you'd be like, again, Mark, to your point, like, yes, can I do this again, right? Can
Right.
this scale at this same rate,
Yeah.
right? Because if it could, you know, I mean, you'd be a fool not to.
And just to be clear, this isn't a 13% return on your money. This is 13 times as a
13
multiple.
times,
Right.
yes.
So that's easy to lose track of. there, but yeah, good
Yeah.
stuff.
Now we get to the next slide, and this is really interesting. And this is where, we kind of run into an issue here, right? We run into a problem,
Right,
so to speak. And we start looking at, well, what's our net profit? Not just in dollars, but also in percentage, because the percentage is really where, in my opinion, we're grading efficiency, right?
right,
The higher your percentage is, the more efficient you are, and kind of the better grade, so to speak. Now, obviously, we can't like underpay a bunch of people, right? That even if we got a good grade doing that long term, that's not good for the business, right?
right, right,
We've got to do things that are good for the business, but this is really our efficiency grade. And, Mark, this is where this is again a concept that you talk about a lot. We're growing in sales, right? As a business owner,
right.
man, makes us happy, right?
Hmm.
1.15 million to 1.35 million. And down here, we look at the dollars. Well, we had more net profit dollars this year, 314,000 to 322.
Right,
We're growing in net profit dollars. And then we look at the percentages,
right,
and we actually lost percentage points.
right. Yeah. So in other words, we made $8,000 more, right? And a lot of that, and the point here is that the overhead expenses got out of control, right? To the point
Yep.
where that's where the largest problem is, right? We'll come back to that. But when you're looking at net operating profit, this is the dollars you get to keep. So in year A, you had $314,000 of net operating profit, which means you kept 27% of all the sales that you made.
Yep.
Okay. And then when you're looking at year B, you had 322,000, $8,000 more. But in this particular case, you only kept 24%. So again, went from 27% in year A to 24% in year B. You're 3% less efficient. And this is how companies grow broke, is that they're not paying attention to that net profit margin percentage because now you're less efficient at keeping dollars. So again, if you keep on this trajectory, eventually you're going to get to a point where, now this is why it's important. It's not necessarily a bad thing. It's not DEFCON 1, because maybe in the transition from year A to year B, you brought on a salesperson, and that salesperson, right, or some other things, maybe it was a new system, whatever it is, and you haven't really hit your full stride with that system. So you're getting the benefit, you got kind of a bump in your sales, but the thing is, you're not efficient at running that thing yet. So it doesn't necessarily mean, again, the numbers just tell a story. It might just be the opening story. So you might say, okay, yeah, but this is year B. We're at 100, we were 1.35 million in sales, but we're already projected to hit 1.7, and all of our costs are basically fixed at this point. There's no commissions being paid out or whatever it is, or we know that we know what our numbers are going to be. So we know our net operating profit margins are probably going to be closer to 29% this year because our revenues are so high. Again, it's just a thread to pull on. Doesn't mean it's bad inherently, but what's the story? This is the sort of stuff that you need to start paying attention to. And so it's a great tool in your toolbox when you're looking at the operational efficiency when it comes to net profit or net operating profit.
Yes, for sure. And just again, having a really good handle on the circumstances, I think is really important behind these numbers, right? If we, I'll do the flip side of your kind of narrative that you gave there, which is maybe our overhead's not capped. Maybe we haven't reached our full like break even point yet. And
Yep.
maybe, sales are continuing to grow, but maybe we're still continuing to see a drop in profits, right?
Right.
Or maybe we're increasing in dollars but declining in percentage points, right?
Right.
Those are all really important things to consider. And, I want to then I also want to kind of rewind and take everybody back for a minute. We also took on a lot of debt in year B that we have to service in the coming years. And
That's a
so,
great point. Yeah.
we have to have profits in order to pay back debt,
Hmm.
right? And, as we've laid out the income statement here, it's a great point for all business owners. You don't get to deduct your debts, right? That doesn't come out of profits. That comes after profits. That's
Right.
like below the line down here, right?
Right.
So you're going to pay taxes on this 24%, and then you're going to pay your debts.
Hmm. Yeah. Yeah, because that's a great point. Because you pay on what you make, right? Even after the debts are, yes, granted, it's an expense and all that, but still, it's an important thing to consider. Yes, the interest, of course, does get deducted as an expense, but you still have debt service, and if your
Yep.
debt service is 400,000 a year, it's not going to matter what your interest deduction is because you're bleeding money. Now it's just you're going to dwindle your cash reserves because it's got to come from somewhere, or you got to take on more debt. So the one thing that I really like that you illustrated here, and I want to just point this out, is like, well, what if you're mid-year and you don't have a guy, you don't have a CFO, your CPA doesn't really do this. And just let me make this point, a lot of CPAs do not do this. I mean, I'm not here to rag on CPAs. I think what they do is, I mean, they are worth their weight in gold. But many of them don't do this because they're so worried about tax compliance. They're worried about keeping you out of jail. And I'm totally fine with that. Right. But
Yep.
they're not going to do this sort of thing unless they're really specialty in this. But one of the things that if you are, let's say that you are, year B plus Q1, right? You're in the first quarter in year C. Now I'd be like, okay, so what do I want to do? What I want to do is I want to look at basically period to period review. So what Ryan is illustrating here is year A, the entire year A, and then he's illustrating the entire year B. So what I would probably do is have this exact same income statement drawn up for Q1 in year B and then Q1 in year C. So now I can look at that and say, okay, am I actually heading in the right direction? What are things going? And this is why it's important to look at period to period, because chances are, again, Mike's in the construction business. Mike's season of being busy is generally not in the early spring, right? So you want to make sure that the revenues, and the comparison numbers are in alignment. You don't want to look at like the middle of the summer in year A and compare to the spring in year C. That makes no sense, right? Because the level of activity is going to be different.
Yep.
So this is a really good way to break that down so you're making sure that you're looking at apples to apples.
For sure. Love that. Yeah, especially if you've got a business with seasonality.
Right.
Yes. And yeah, I think a good quarter by quarter analysis, and again, look at dollars and also look at percentages. Really, really good thing to do for all business owners, whether you're seasonal or not, even if you're
Right.
not seasonal, right? Even if
Right.
your business is steady every single month, you can still look quarter to quarter. Am I growing? Are my expenses that are increasing in dollars on point with, percentage wise, right?
Right. Right.
Same percentages, right? Is my business still being as efficient? Those are all things that you can look at when you start looking at percentages.
Right. Right. The one thing I think that you brought up a great point earlier on is that they were bringing up their pricing as they brought in, more dollars. But here's what's interesting though, is you have to stop and think about it in terms of what margin you're trying to protect. So in other words, if I was trying to protect my margin, and let's just say they got no additional clients, what I would have gone back to my clients with is they probably went back to the clients with a 20% increase in price, right? Which is why the net profit declined by 3%, right? Because if you interpolate those numbers, you'd say, okay, well, if you only went to them with a 20% increase when the margin was actually a 27% margin, that would explain why it's at 24%, right? Because
Yep.
you didn't raise your prices enough. So this is also why, if you look at Wall Street, this is also why companies tend to do really, really well in periods of inflation because they raise their pricing more, their revenue dollars are higher. What does Wall Street love? They love to see higher revenue dollars. They love to see revenue growth. They also love to see profit growth. So in this situation here, they didn't raise their pricing enough. So that was going to be more of a problem. So when you went from 27% to 24%, they actually didn't protect their pricing. And that was the biggest problem.
Yes. Love that. Love this example. I think as an audience, rewind this, watch it again. And then, there's some big takeaways here, I think, which is, if I was to summarize just really quickly, number one, don't just look at dollar figures, right? Always look at percentages as well to see how that moves in relation to your sales.
That's right.
And then number two, we gave you a great exercise to do. Look at things quarter by quarter, you can do it year over year for sure.
Yeah.
But, if you see a trend like this in your business where it looks like, oh, wow, we kind of lost some efficiency here, then it is the best thing to do is to follow up in year C, so to speak, quarter one.
Right.
Or, you could do it month over month too, but looking at a quarter, I think, gives you a little bit bigger of a sample set.
Right.
And look at, what did we do year B quarter one compared to year C quarter one?
Right.
And look and see what those numbers look like. Obviously, for a construction business, might be in your slow period, but you can still look year over year and see how you're doing.
That's right. Yeah. Good stuff.
Love it. All right. Well, until next time, everybody, go accelerate your profits, and we will see you next time. Again, Mark, thank you so much for taking the time and doing this with me today.
This is so much fun. Thanks, Ryan.
Thank you.
Thank you for listening to the Net Profit Podcast with Ryan Kimler. Make sure to subscribe or follow the show on your favorite podcast app. Don't forget to check the show notes for our guest contact information and to connect with Ryan on his website, netprofitcfo.com.